Hello, welcome back to this new video. In this, I'm going to read my national income notes of for ESI topic of NABARD Grade A examination. So in this series, what I'm basically doing is I am just revising or reading my notes that I have subscribed to, and my main goal for this initiative is to be consistent and focus upon my completion of targets. So let me begin. Definitions. National income. National income is the aggregate of the factor incomes earned by the normal residents of a country in an accounting year. It is the sum total of the factor income such as wages, salaries, rent, profit received by the factors of production, that is land, labor, capital and entrepreneurship. It is presented in the form of net national product at factor cost. Important concepts under national income. Let us see. NNP at factor cost, aggregate of income earned by normal residents of a country in an accounting year. Yes, fine. Then important concepts: domestic or economic territory administered by government of India in which can circulate. Foreign embassies located in India are not part of domestic territory, whereas Indian embassies located abroad are a part of domestic or economic territory. Yes, this definition is good. Thus, domestic or economic territory also consists of the following: military establishment, consulates, embassies, etc. Market price. It is the price that a consumer pays for the product while purchasing it from the sellers. It is the price at which the units are sold in the economy, taking into effect the indirect taxes and subsidies. Yes, fine. Example: base price charged by refinery is 60 rupees, excise duty plus value added tax is 30 rupees, market price paid by the customer becomes 90 rupees. Then we have factor cost. It refers to the cost of factors of production that has incurred by a firm when producing a certain good or service. Okay, fine. Total factor cost. Factor cost is equal to market price minus indirect taxes, whereas net indirect tax is equal to indirect taxes minus subsidy. Depreciation or consumption of fixed capital. It refers to the loss in value of a fixed asset which are in use due to wear and tear, accidental damage or obsolescence. Textile factory purchases a machine of rupees 10 lakh. After 1 year of use, the value falls to 8.5 lakh, depreciation of 1.5 lakh rupees. Net factor income from abroad. Difference between net factor income earned by normal residents of India who are temporarily resident abroad and factor income earned by non-resident temporarily residing in India. Factor income from rest of the world minus factor income to residents of the world. What they are saying, difference between the factor income. This definition is not up to date. It is net factor income abroad just includes NNP plus net national product plus remittances earned by normal residents. Okay, fine. We can manage with this. See this NFIA transfer payments. Transfer payments are unilateral payments corresponding to which there is no exchange of goods and services in the economy. Gifts, donation, old age, disability pension, scholarship. Measures of national income. GDP. It includes the aggregate production of final goods and services taking place within domestic economy during a year. Gross domestic product. GNP. GNP is an estimate of total value of all the final goods and services turned out in the given period by the means of production owned by country's residents. GDP, and this will include total value owned by country's residents. GNP. GDP is equal to GNP is equal to GDP plus net factor income from abroad. Then we have net domestic product, NDP, GDP minus depreciation. Net national product, GNP minus depreciation. So one thing that I had remembered for during my UPSC preparation was, whenever they are giving you the word, asking you the word net, you just have to minus depreciation, that is it. And whenever they are telling you gross, you need to add something to the value. GDP at market prices. GDP at market prices is the market value of all final goods and services produced within a domestic territory of a country. Okay. GDP at factor cost. GDP at factor cost is equal to GDP at market prices minus indirect taxes minus subsidies. GDP at factor cost. National income is equal to NNP at factor cost. National income at factor cost is equal to NNP at market price minus indirect taxes minus subsidies. Now read the definition. Now again read the definition of national income. You will be able to understand well. Okay, fine. History of national income in India. First attempt to estimate the national income was made by Dadabhai Nauroji in 1868. The annual per capita income, PCI, computed by him was 20 rupees. The first scientific method to compute national income was used by Dr. V.K.R. V. Rao in 1931 to 32. In doing so, he divided the Indian economy into two parts: primary sector, which included agriculture, forestry; secondary sector, which included industries, construction, transport, etc. He computed rupees 62 as the per capita income of India, and the annual per capita computed by Dadabhai Nauroji was 20 rupees. The first official attempt to compute national income was made by P.C. Mahalanobis as the head of National Income Committee appointed by Government of India. The committee also had D. Gadgil and R. V. Rao as members. The first report of the committee was presented in 1951, according to which national income of India was 8,000 crores and per capita income was 225 rupees. Current scenario. Later, the task of estimating GDP was transferred to the Central Statistic Office, and a fully developed national income division under CSO was created at the national level. Since 1955, the national income estimates were compiled by CSO based on the national level survey conducted by National Sample Survey Office. However, in 2019, CSO and NSSO were merged to form National Statistic Office, and today NSO has responsibility of estimating national income in India. Importance of calculating national income. Measuring size and growth, basis of economic planning, measurement of standard of living, sectoral contribution, assessment of government policy, factors affecting national income, availability and quality of factors of production, technological progress, natural resources, institutional and policy framework, level of capital formation. Fine. Circular flow of income. Circular flow of income describes the movement of goods or services and income among different sectors of the economy. It illustrates the interdependence of the sector and the markets to facilitate both real and monetary flow. The real flow refers to the flow of factor services and the flow of goods and services. The movement of the money from one sector to the other sector corresponding to the real flow is referred to as monetary flow. The income of one sector becomes the expenditure of the other. The supply of goods and services by one sector becomes the demand for other sector. The real flow and monetary flow move in a circular manner in an opposite direction. Fine. The continuous flow of production, income and expenditure is known as circular flow of income. Before understanding circular flow of income in depth, we need to understand the four macroeconomic sectors and the three markets. The four macroeconomic sectors. The household sector. This sector includes all the individuals of the economy. The primary function is to provide the factors of production. The firms sector. This sector includes all the businesses and business entities, corporations, and partnerships. The primary function of this sector is to produce goods and services for sale in the market and produce uh, for the sale in the market and make factor payments to the household sector, the government sector. This sector includes the center, state, local government. Foreign sector includes rest of the world. Foreign trade implies net exports. Exports include goods and services, etc. The three markets: the goods market, the factor market, and the financial market. In this market, goods and services are exchanged. Factor market, factors of production are traded through this market. Then financial market consists of financial institutions such as banks and non-bank intermediaries who engage in borrowing and lending of money. Circular flow of economy in two-sector economy. The model assumes a closed economy, meaning there is no international trade, no imports, no exports take place. The economy consists of only two sectors, household sector and firm sector. This is a closed economy model. Closed economy model. Role of household sector: it is the only buyer of goods, it is the only supplier of factors of production, it receives income from firms, it spends entire income on consumption, there is no saving in the economy. Okay, fine, this is just about the closed sector. Circular flow of income in three sectors. The model assumes a closed economy, no external trade in three sectors vis-a-vis household, firms, and the government. Factor payments, household, government household relationship, government firms relationship, role of financial sector in three models. Fine, this is just that these stakeholders are so intertwined with each other that they have become like a symbiotic relationship. Like the household is supplying factors of production, like the firm is supplying them money or monetary value through which the household is able to satisfy their monetary demands. So these are just the explanation of how government, firms, and how households are all interconnected, and this is what we call a circular flow of economy. It is a closed loop basically. Circular flow of economy in four sector model. So they have added a new sector, that is what? Labor, they have added businesses, I think, in this. Four sector: household, firms, government, and now external sector will be added in this. Understanding individuals, commodity market, government, foreign sector. Let us see what foreign sector is talking about. The inclusion of the foreign sector expands the circular flow through international trade services, money move out between domestic and economic. Okay, so this is like how Indian residents are sending what we can say remittances, etc. Interaction between household and foreign sector. Injections and leakages, this is important. We can skip this because basic economics just covers this part. There is nothing new, this is just jargon. This is just jargon. Injection. An injection refers to any addition of income into the circular flow of an economy. It represents spending that enters the system and increases overall economic activity. The three major injections are investment, expenditure by firms on capital goods such as machinery, yes. Government expenditure, government spending on goods and services. Exports, spending by foreign buyers on domestically produced goods and services. Leakages, a leakage refers to withdrawal of income from circular flow. Now let me just highlight this. It represents portions of income that is not spent on domestically produced goods and services. Savings. Leakages occur when income is diverted away from the goods market. The three primary leakages are savings, the portion of household income that is not spent on consumption; taxes, income paid to the government, reducing disposable income; variables, imports, foreign for the uh, for the economy to remain in equilibrium, total injections is always equal to total leakages. Fine, I understood this. Method of computing national income. The value of the burger, okay. So it is basically a value addition method, a income method, an expenditure method. There are three types. 1, 2, 3. Income method. In this, GDP is calculated by adding factor income earned by all households in an economy. So GDP at factor cost is equal to wages plus interest plus profit plus rent. Items not included while calculating GDP from income method: death, duty, income, transfer incomes, etc. etc. This expenditure method is very important. This method calculated GDP by looking at the expenditure from all the sectors. Whatever goods and services are produced in the economy are ultimately purchased by the four sectors of the economy. If we add expenditures, this is very important. GDP at market prices is equal to what I remember it like CIGSM, like CIG X minus M is net import minus export minus net imports, and this is capital investment, this is consumption, this is investment, and this is government spending, if I'm correct. Consumption, investment, government spending. Okay, fine, we are correct. Value added method. Let us see value added method. In this method, gross value added is calculated, which is equivalent to the gross domestic product. GVA is equal to GDP at factor cost. Okay, what value are we adding? It measures the domestic income at the level of production. Let's understand through the example. We don't want such examples. Value added is a method which only sums up the value addition at each stage. It gives an idea of how much value each firm or each sector is adding to the product or services. Okay, fine. Let me just do this, and now we are good to go. It gives an idea of how much value each firm or each sector is adding to the product or service. Fine. GDP calculation in India. In India, GDP is calculated by National Statistical Office. The GDP is calculated using expenditure, production, or income method. Expenditure and or income method. New base year is 2022-23. The base year of GDP has been revised from 2011 to 2022-2023. 26-member advisory committee on national account statistics was constituted by MOSPI to revise the GDP base year. It was chaired by Professor Biswanath Goldar. Okay. Reasons for revising the base year. In the decade since 2011-2012, India's economy has transformed drastically with new industries emerging. There has been a change in consumption patterns and investment behavior. Over the years, extensive digitalization has also opened up new data sources, and incorporating these data into national accounts will improve accuracy and detail. The year 23 was chosen as the new base year because it is the most recent normal year. Okay, fine. The GDP is calculated by using both base price and current price. Let's understand the calculation. Now, by using expenditure, GDP is calculated. This formula. Changes in stocks. Changes in stocks refers to the change in inventories held by a producer during a year. It includes raw material, work in progress goods, finished goods. G, because GDP measures production, not just sales. Variables. Goods that are produced not for consumption but for storing wealth. For example, gold bars, silver, precious stones, art, paintings, and antiques. Coming back to GDP table, okay, so this is all about that, explaining the table. Real GDP and nominal GDP. It is inflation adjusted measure that reflects the value of all goods and services produced by an economy in a given year. It is GDP at constant prices. This is very important. GDP at constant prices, inflation adjusted. And it is GDP at current prices, nominal prices. In the above value nominal, okay. GDP deflator. The price index that measures the overall price level of all goods and services included in GDP. It shows how much nominal GDP is due to price rise. The price index that measures the overall price level of all goods and services included in GDP. It shows how much nominal GDP is due to price rise. GDP deflator, just remember this formula, that is it. Nominal GDP growth is equal to real GDP growth plus inflation. Other variants of national income, private income. Okay, private income. Then what is domestic income accruing to the private sector? Domestic income accruing to the private sector, it is the sum of total income minus income accruing to the government sector, which accrues to the private sector. What is national debt interest? Government of any country borrows money from its general public by issuing securities, bonds, etc. to meet its rising and consumption expenditure. The interest paid on such debt is source of income for private sector, hence it is included in private income. Personal income is equal to private income minus corporate tax minus savings rate of private corporate sector. Personal disposable income, PDI. Personal income minus direct taxes minus miscellaneous fees paid by the households. National disposable income. National income plus net indirect taxes plus net current transfers from residents of the world. GDP plus GDP and welfare. Welfare refers to the overall well-being of people in an economy. It includes material standard of living, access to health, employment security, clean environment, income equality, social and psychological well-being. Thus, GDP per capita is often used as a rough indicator on living standards. However, higher GDP does not necessarily means higher welfare. True. Limitations of GDP as a welfare measure of welfare. Distribution of income is ignored. Yes. This is also important. I think they can ask us question in phase 2 examination of NABARD regarding this. Then we have non-market activities are excluded, like household work is excluded. Environmental degradation is ignored. True. Defensive and regrettable expenditures are included. Leisure and work-life balance are ignored, like quality of life, quality of roads, quality of public healthcare, education is also ignored. Quality improvements are not fully reflected. Population growth and per capita consideration. Okay, fine. Indian context, growth versus welfare. We know this dilemma. Green GDP, let us see what green GDP has to offer. Is an adjusted measure of a country's economic growth that takes into account environmental consequences and economic activity. Fine. Calculation of green GDP, deduction of pollution cost and adjustment of resource depletion. That will give you a green GDP. That was it for this topic of national income. I think just we need to brush off some definitions and formula for GDP calculation and revise its base year, etc. So yeah, that was it. Let us start with a new topic in the next video. Thank you.